Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. And we have one of them here with us right now, Mandeep Singh. He's Bloomberg Intelligence Senior Technology Analyst on this ASML news. So let me update you on what we see. ASML has been halted a few times for volatility. The stock dropped like a stone after cutting its 2025 net sales and gross margin guidance, and its third quarter bookings also missed estimates. And these guys make the machines that you need to make AI chips. Mandeep, is this a negative sign for AI chip demand?
I mean, look, when it comes to ASML, everything is driven by CapEx. And when I say CapEx, it's really coming from the foundry guys like TSMC, like Samsung. We know Samsung had layoffs recently, so clearly they are not doing very well, but TSMC is. So the fact that their buyers are so concentrated and the geopolitical tensions continue and, the second half estimates, the comps are tougher. To me, this is just a sign of expectations kind of going up to the point where you will not see any positive revisions from the print this quarter. And that's what happened with ASML. Expectations had gone up, and they didn't surprise to the upside. So we could expect the same from others.
The magnitude of the miss on the orders versus the estimate seemed huge to me.
Yes.
Is that typical or not typical? When they miss, they really miss?
Well, so that comes down to how semis typically is. When you go back to prior cycles, when these companies miss, they miss big. We have seen that with Micron. We have seen that with some of the other names. But in the case of ASML, the secular drivers are intact. When you think about, every foundry looking to use their machines, looking to go to, smaller nodes, TSMC actually doing very well. So they are their largest customer. And when you think about, how well TSMC has done in terms of their AI revenue, I don't think they are cutting back CapEx, but it's always about that incremental buyer when it comes to these semi companies, especially the ones that are reliant on CapEx spend. And if you take China out of the equation or the fact that they are restricted in some way, those are some of your incremental buyers. So that's where it has an impact.
We have a great function on the terminal. It's SPLC. It's a supply chain analysis. So if you type in ASML and then go to supply chain, you can see who their competitors and their customers are. So competitors are Applied Materials, KLA, Lam Research. So you can kind of see all of them are going to be down on this news. And then to Mandeep's point, customers are folks like TSMC, Samsung, Intel also, although albeit not a huge customer anymore, but the problems that Intel has had, semiconductor manufacturing, Micron, so watch that stock, SK Hynix, am I saying that right? Hynix,
that's on the memory side.
Yep, and then you have Global Foundries as well. This is a really ignorant question. Where does NVIDIA sit in this story that we're talking about?
Well, NVIDIA is sort of the first derivative. So if TSMC is not buying machines from ASML, that means they are not expanding their supply for the latest CoWoS packaging and the foundry side in terms of manufacturing NVIDIA's chips. So TSMC determines what kind of capacity expansion they are looking for 2025 and beyond. And based on that, they are placing an order for ASML equipment. So it is a very big sign. And to your point about Intel being a buyer, well, Intel is under pressure to curtail their CapEx as well. So you're taking a lot of the incremental buyers out of the equation, even though there is no substitute for ASML. So it's not as if ASML is losing market share to anyone. It's just the incremental buyers are fewer compared to where they were, a couple of quarters back.
Okay, what I know about AI, you can put into a shot glass. So answer this question like I'm a 5-year-old. Does this fundamentally change the AI story for tech?
It doesn't. It's just that everyone is expecting some sort of a digestion period when it comes to AI. We have had, a long up to the right sort of scenario so far when it comes to generative AI, and everyone expects a pause at some point. The signs are, NVIDIA's chip demand remains insatiable despite the restrictions. But when it comes to, semis, the way it works is first your foundry guys are going to slow down their supply expansion. Then, NVIDIA will see fewer beat and raises. And so there is a derivative aspect to how it flows through. It doesn't all happen in the same quarter. And to me, ASML missing is one of the first signs that, things may be cooling down a little bit. It may not get reflected in NVIDIA's quarter this time around, but 2 quarters down the line, NVIDIA could get affected.
Which then also raises the question, like, which customer is the problem for ASML? Like, what if their customer list are calling them saying, like, guys, look, we don't really need the equipment. Like, we know it may not be TSMC, so then is it Intel? Because that's more of an idiosyncratic Intel issue rather than like a broader AI chip story issue.
Yeah, and Intel and Samsung. I mean, look, Samsung we know isn't doing very well on the manufacturing side. When people talk about generative AI chips and GPUs, everyone is going to TSMC as if they are the only game in town. Samsung isn't able to make that latest switch to that latest node for generative AI chips, and that's where we heard Samsung doing a layoff. So clearly they are curtailing their costs. Intel is curtailing their costs. So you take out 2 of the top buyers of ASML gear, and we know they sell, multi-million-dollar machines. So these are expensive purchases, and it's not as if ASML is losing business. It's just it won't get reflected in the next quarter or the couple of quarters.
So this ASML U.S. depository receipts down 12%. Is that a reasonable reaction, do you think, in this market?
I think so. I mean, given we are seeing some gross margin compression, and for semis companies, gross margin is huge. Anytime you see gross margin compression, that is your first sign that, things aren't going your way, and it's a sign that the demand is somewhat cooling off or your costs are going up. In this case, I think it is a function of orders getting delayed, and I think the reaction was warranted. Probably we may see an overreaction today.
Sure.
People may realize they still have a strong mode tomorrow and then buy the stock, but I think the reaction was warranted.
We've been looking for this, like a little bit of a hiccup or a little
or crack or just something,
yeah,
right?
Something,
like
right.
Not everything is sunshine and roses like all the time. Mandeep, we really appreciate it. Thanks for the hustle, Mandeep Singh. Is there anything you don't know?
No, I mean,
I wonder if we talk to him about like
he's the most
Adidas, he'd probably have
overeducated tech
opinions.
analyst on Wall Street.
For real.
Right? I mean, he took stuff I was funding back in the day for you. Unbelievable.
Mandeep Singh, Bloomberg Intelligence
He's playing
Senior
wounded, by the way. He's got a
Technology
cast
Analyst.
on, so who knows what's going on.
Oh, okay. Well, we'll get that in commercial break.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Man, these banks just crushed it today.
I know.
mean, really, really,
And what
really
I'm seeing
solid numbers. Although Goldman Sachs stock is now down by about 0.7%.
Really?
Yeah, isn't that's actually kind of surprising for me. But I'm taking a look at, say, Bank of America. That stock is also down now by 0.8%. But on the surface, these numbers looked really great. Citi stock.
Yeah, I thought, and the
also
capital
down
markets,
2%.
the capital markets, the trading business, I thought did very well. But I know the street likes the more predictable fee business, I guess, I suppose.
Yeah, but they didn't seem to care about that when it came to JP Morgan and Wells Fargo.
That's
you know who might know the answer to this?
I think I know.
Alison Williams, Bloomberg Intelligence Senior Analyst for Global Banks and Asset Managers. So for my, Luddite read here, they were really good numbers, and then the stocks are down. Tell us why.
They were, and it is all about the expectations. Keep in mind that we did get sort of a change in expectations, not necessarily baked into the numbers with the reports on Friday, the very strong trading and fees for JP Morgan, which set the tone, and the banks delivered on today. Net interest income, which, for JP Morgan, basically they had talked it down in September, then they beat the numbers and raised 4Q guidance. But Jamie's still talking negatively about next year. And for Bank of America, really, they did exactly what they said. Net interest income troughed, the number came in, and they are not going to talk about guidance for net interest income until the next call for next year. So I think the stock is probably fine, just reacting to things coming in basically as good, but versus sort of raised expectations.
What's the expectation here for when you talk to your investors about just regulation of banks? I mean, where's that headwind? Because I know it has been a headwind off and on for really since the great financial crisis. Where are we now with the Basel endgame?
Yeah, it is, and it depends on the election.
Okay.
At this point, right? So if Trump wins, then the rule could be derailed sort of indefinitely. So that would be positive for banks. If a Democratic win, will sort of continue on the same path. So Basel, the rules were very onerous that were introduced last year. Basically, we've gotten the signal that they're going to be lighter. We sort of had those expectations set within the last several weeks, but we're still waiting for that proposal.
When we just break down the broader sort of investment banking, can we say M&A's back?
So,
they seem to be talking good about it. That's not a sentence. They seem to be talking really positively about M&A.
So it is, and so from Goldman Sachs, who's the leader in M&A, very good numbers, and the fact that their pipeline is up sequentially is very good. But fourth quarter does tend to be seasonally strong, so we do have to see: is it just the typical seasonality, or is there a little bit more momentum?
Are all our friends on Wall Street, are they going to get paid really well this year?
I mean, bonuses do look good for this year, especially for debt fees. I mean, really,
September alone, they
huge
should have a
highlight.
good year.
Underwriting, right, was really quite strong across the board. What are some of the questions that you have now? And whichever bank you want to focus on. What's a big glaring...
So, the election is going to be important in terms of what that means for the capital rules. I think that's sort of the big structural question. Markets are strong. Things look good. That momentum is likely to continue in the fourth quarter. I think maybe the next thing that we're looking at is... can we get signs of improving loan growth? Because that is really, net interest income, that recovery is what investors are looking for. Can we get momentum there? The other side of the lending business is credit, and all signs are pointing pretty good right there.
All right, as a former Citi banker, I have an interest in that institution. Where is Jane Fraser in the turnaround of that bank? And does the street believe that she can get it to the point where it generate really competitive returns?
I think, the street has been burned so many times for getting their hopes up on Citigroup over the years. And so Citigroup is delivering on what they want to do. We saw that in the numbers this quarter. They, like the other banks, are getting a lot of upside from markets, but keeping the costs stable. And so for them, it's really, these regulatory headwinds, which are so hard to predict. And, I think the best thing that could have happened to Citi is this, regulatory scrutiny that finally is making them, make a lot of the changes that probably should have been done a long time ago. Getting the risk systems together, improving their operating efficiency, which at the end of the day will be helpful in the long term.
On Friday, we talked about Wells Fargo in particular, and you were saying that the big question you have is when do loans pick up? When do loans pick up? And what did we learn from, say, Citi and Bank of America on that?
So it's hard to say. I think it's going forward, right? So the Fed cuts happened in the last couple of the weeks of the quarter, so we're not necessarily going to see the impact of that right away. Maybe the senior loan officer survey will give us a little bit of insight when that comes out in a couple of weeks.
All right, we got Morgan Stanley tomorrow, I believe.
Morgan Stanley tomorrow. They have really raised the bar for them. All these banks, especially Goldman, strong numbers today. So we'll see if they can deliver on that. They tend to be more skewed towards equities trading. That's been the source of strength. So we'll see.
And are they going to be like past cycles? They being the big banks, like next week, all issuing debt.
Yep, that tends to be the focus. One more thing I'll add about them, while the institutional, there's a lot of positive momentum. I think it will be all about the wealth flows for them. So they will need to If they get institutional right and ride this wave with everyone else, that's great. But they do need to deliver and show that wealth business is continuing to gather assets.
Which they always have,
the markets should be very helpful on that front as well.
Right, because it's an expanding pie that they're all competing for now, right? It's not like one tiny pie that isn't growing at the end of the day. One more question about Goldman, and this is a little personal for me because I have a Marcus account. For their consumer banking.
They called that out in the quarter. They called that out.
Did they? What did they say?
No,
did they say that they're lowering rates a lot? And
they just
kind
said
of
Alix Steel inflows were noted during the period.
Well,
4.1 now.
Yeah, it just went down.
I just got another message.
I mean, come on, guys. Like, they just lowered once. Anyway, how are they doing on offloading all the risk and stuff for their consumer business? I know that they already offloaded a lot to GM. They took a write-down for it or a charge for it. Where are they in this process?
Yeah, so one step closer with the sale of the GM portfolio. They are hanging on to Marcus, but, Fed lowers rates. That positive for the banks means that there's less competition, less competitive pricing pressure, but for the consumer, not as favorable.
Yeah, you know what I'm going to do? I'm going to find something that is competitive. I'm going to go to those munis. Like Paul's been saying, like, see you later, Marcus. I'm taking my money and run.
Free.
Yeah, but you can't pull your money out at a moment's notice.
Marcus?
No, with munis.
I know, but I'll know, like, in general. I should have known when John Tucker got a Marcus account that was the top.
Yes.
Oh, you're blaming me.
Yeah, totally.
It's my fault.
All right, Alison, thanks a lot. We really appreciate it. Alison Williams, Bloomberg Intelligence Senior Global Banks and Asset Manager Analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's talk Boeing. They are back in the news again. And when we talk Boeing, we talk George Ferguson again. George Ferguson, Senior Aerospace Defense Analyst for Bloomberg Intelligence. George, I like this move. Boeing puts up a $25 billion shelf offering, gives it some flexibility to shore up its balance sheet. I know we have to talk about dilution, but tell us what Boeing is doing here with this $25 billion shelf.
Yeah, so I think Kelly Ortberg went out and brought up the big guns, right? So I think he wants to shore up the balance sheet. I think so he can show the union that Boeing has plenty of cash to make it through this strike. I think that's part of his strategy to get the union back to the table and get them to rethink probably some of their demands. But that's what I see here.
And what is the sense of their balance sheet? Just give us a sense, George. I know you've been calling it out and highlighting it for us for quarters now. Talk to us about kind of the cash on their balance sheet, the cash burn. How long can they go before they really do need to think about fresh capital?
Yeah, so I think they need capital now, right? And so I think it is part of why Kelly Ortberg and Boeing are going to the market because, they just pre-announced earnings for the third quarter. Cash balances were right around $10 billion. That's about what they've told us they need to operate the company. So I think that really put their back up against the wall. As you know, they're managing a dance with the creditors as well because, they're really up against the edge on their investment grade credit rating. So I think it really precluded going to the debt markets here. And so, I guess the question is too now is it's of staying power, right? And how long can Boeing manage with the $10 billion? They couldn't manage very long a strike. And so to get better negotiating leverage with the unions, I think if you put another $10-15 billion in the balance sheet here, I think it gives you at least a quarter, probably multiple quarters of potential cash burn. So you could tell the union, look, I'm gonna wait this out until you bring me some demands that I can meet.
Just hold that thought for 1 second because I want to point out ASML, which is a company that makes lithography machines so you can make AI chips, is now halted after a steep drop and earnings that did not look great. Third quarter net sales did come in higher than estimated, but their third quarter bookings fell below about 2.63 billion euros, substantially below the estimate. They're also taking a look at 2025 net sales, also below estimates. This is quite quite interesting read-through for AI. Again, they make the lithography machines that help make AI chips, and that stock is now halted after falling steeply after those numbers came out.
That shocking.
Shocking, right? Let's take a look at NVIDIA, too.
I'm looking at
see what
NVIDIA
they're
down
doing.
4.4% just on that news, just in the last couple of minutes.
Okay, so not only just from the news over the
Yes.
over the night.
Yep.
George, before I let you go, how much time does this buy Boeing?
I think it buys them at least a quarter, if not more. I mean, look, I think if you're negotiating with the union, I'd be really surprised if the average union member is ready to go a quarter without a job. And so, without income, I shouldn't say without a job. They have a job at Boeing, I guess, but without an income. So I think it gives them plenty of staying power. And I think that's what Boeing has to do here, right? If they're going to get the union to come back to the table and negotiate in good faith, they have to be able to say, look, we're not over a barrel. We can wait you out. Now let's talk about some of the issues, especially, I think, the pension plan, right? The unions talked about a return to pension plan. I don't think any major corporation has given back on a pension plan since they've retired them over the last number of decades. So I think they have to be ready to go the distance to not have that happen.
All right, George, thanks so much for joining us. George Ferguson, he's a senior aerospace, defense, and airlines analyst for Bloomberg Intelligence. Just kind of talking about the Boeing news here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. And we are broadcasting to you live from our inactive broker studio right here in Midtown Manhattan. As John Tucker was just talking about, you're looking at crude off by over 4%. And the only headline that you could really find was perhaps Israel will not be targeting Iranian oil infrastructure. So it raises the question, are we looking at geopolitical risk being priced out? Also, the IEA revised slightly down demand forecast for this year and next. Mostly a China story, but nonetheless. Dan Pickering is Chief Investment Officer at Pickering Energy Partners. He joins us from Houston, Texas. He's honestly one of the best in the industry. He's been around a long time. He's kind of seen it all, and he has a great insight into what companies will do as well. What's your take on crude off by $3?
Yeah, Alex, good morning. It's definitely this news that we potentially are not going to see any escalation of the violence in the Middle East. If Israel doesn't hit the Iranian oil facilities, then we have kind of continued status quo, which is oil has been flowing out of the Middle East with no problem. And so we're taking the air out of the risk of supply disruption and getting back to a more fundamental market, which has been pretty soft over the last couple months.
What's the fair price, you think, for oil?
Yeah, fair price for oil. I'm an $80 through 2027. That's my forecast. But I think 2025 is going to be tougher. Fair price for oil in 2025 is probably 70, give or take, maybe a $5 band around that. If we have challenges in the Middle East, all bets are off. If it's supply and demand, my expectation kind of 70 to 80, 65 to 75, something like that.
Dan, I always joke or often joke that my next life I want to come back as an energy M&A banker. Every Monday we come in, it seems to be something on the Bloomberg terminal. Talk to us about consolidation in the energy space. Where are we? What are you likely to see over the next year or two?
Yeah, so it has been a very active M&A market with companies focused primarily on four things. They're adding inventory, they're going for size, they're looking for scale, and it's happening at pretty good values. And so because the market has not been that interested in energy, right? It's an underperformer last year, it's an underperformer this year. Because these stocks are pretty cheap, the companies are buying each other. And as they're doing that, they're replenishing the inventory that they drilled up during COVID. They're getting bigger, which is important. Bigger companies are getting more attention from the market. They're getting more profitable, and they're doing it at 3 or 4 times cash flow. All of those attractive things. It's going to keep going.
Yeah, Dan, that's such a good point because, first of all, I want to point out, Paul, you wouldn't want to have been an M&A banker like a few years ago.
No.
There was like a whole lot of nothing happening. But the idea is if you're an investor or you're a pension fund or something, like you can't own a huge bunch of oil stocks. Like your investors are not going to like that. So it's like you have to gussy yourself up to be the top 1 or 2 oil players out there. So to that point, who needs to still buy stuff and who needs to be sold?
Yeah, I think if you look at all levels, companies are trying to get bigger, whether it's Exxon buying Pioneer or you move down into much smaller market caps. So I think that we'll continue to see probably 50 billion as a give or take the point of relevance for the broad markets. And so my expectation is folks that are below that are going to keep buying, trying to get to that size, and that folks that are sort of smaller than Exxon are going to keep merging. So it's kind of across the board right now, Alex. And again, these companies will keep buying each other until the market decides that they're going to buy the stocks.
And Dan, you mentioned that energy stocks have been underperformers. What is the bull case out there for energy? Is it simply maybe just valuation here?
Yeah, the bull case is strong yields, very good free cash flow. The companies have turned into real businesses since the shale bust, and so they're throwing off a lot of cash, returning a lot of it to shareholders. The other piece is it is an inflation hedge. Nobody's thinking about inflation right now unless it comes back. And then you have this sort of geopolitical element, which is if things do spiral out of control, you're going to want to own some energy stocks. So there's a bit of a hedge, and then there's value. Those are the two arguments for the energy sector right now.
Do you think that oil producers will keep producing more oil? Let me define that question a little bit. Have they run out of the good stuff? And that's another reason why we're seeing the M&A. And I don't want to underestimate shale players because we know that innovation and technology is huge, but they have a lot of other stuff they need to spend on, particularly in the energy transition. So can we count on technology to make the rock good?
The answer is yes on the margin. There's another leg up in efficiencies that's been happening this year. I think the reality, though, is that U.S. shale is maturing. And what that translates to is likely a sort of an upward push on cost structures and upward push on commodity price. Remember, shale's now over much more than half of U.S. production. The Permian alone is 6 million barrels a day. That is a meaningful player in the global market. And so as those assets mature, there's an upward bias to price. Never count out ingenuity and efficiencies. But as this industry matures, we're going to see a slow upward push on cost and price.
And before I let you go, Dan, how do you think the election is going to affect big oil at all? I know that the talk is going to be like, we want oil friendly, blah, blah, blah. But in reality, they're not going to want drill, baby, drill, because they don't want to do that. They're going to tank the oil price. Materially, do you think the election matters for oil companies?
Simple answer is no, Alex. I think that these companies, it may be a little bit easier or a little bit harder to interact and run the business, depending on who gets elected. The reality is that politicians have proved that they want low gas prices. We're not punishing bad actors globally. We're letting them produce their oil. We want U.S. oil. We're not going to punish this industry too much. And the industry itself is not going to step up and get super active unless there's a price signal. So the election, it matters for sentiment and perception. I don't think it matters a ton for reality.
All right, that's great stuff, Dan. Appreciate it as always. Dan Pickering, Chief Investment Officer, Pickering Energy Partners. I've known Dan as a voice on energy for 30 years.
Oh, okay.
And a buddy of mine used to work with him, David Bradshaw, my energy investment banker. He's my go-to guy on all things there.
Nice. Well, let's get him on too.
We will.
All right.
We will.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So the Fed is in a rate cutting cycle at this point. How much they cut TBD, but the idea is that they're in a global central bank easing with the exception of Japan. Does it make certain aspects of the market a little bit easier to stomach, like commercial real estate? So we wanted to check in on that with David Auerbach, Chief Investment Officer at Hoya Capital. He joins us from Dallas, Texas. How have REITs done if we're taking a look since the Fed first cut and then the trajectory now for this year and next? How are REITs performing?
Well, in the lead up to the interest rate cut, REITs performed very well. Post-Fed rate cut, the REITs have not done so well. They've given back some of that return because the 10-year Treasury is back over 4% for the first time since August. With the less likelihood of more significant rate cuts on the calendar this year, I wouldn't expect the REITs to respond accordingly. Obviously, if we can get the 10-year back below 4% again, that should bode well. And the reason being, the cost to borrow for the REITs as they go to refinance becomes more attractive. REITs would obviously be able to borrow debt, would like to borrow debt with a 4 handle or a 5 handle, let alone they don't want to borrow at a 6 handle. So any movement that the Fed is able to go lower on the interest rates only provides some tailwinds for the REITs as a whole.
David, what was the last Fish concert you went to?
Good to see you, Paul. Thank you so much. I was in Colorado at Dick's in Labor Day, and right now my next scheduled concert will either be MSG New Year's Run or Mexico in February.
How did you know that question?
It's in the notes. You got to do your work here.
Oh,
But and if you come to
I don't
Madison
scroll
Square
down.
Garden, if you come to the Garden, you can see Matt Miller. He's there with all his brothers.
And
big
McKee. He's a big
is that
Dead
right?
fan.
Okay.
Oh, no, you're talking about Fish. I'm
Yes.
talking about the
It's
Dead.
kind of same thing.
I mean,
kind of.
yeah, I thought
Well, the
so.
Dead's kind of,
Yeah.
dead.
So, all right, David,
Damn it.
do the banks, are they still lending to real estate, David? If I've got a project, can I go to my local bank and are they going to make me a loan?
Well, for a lot of the REITs themselves, remember, they're able to go out and borrow their own debt. They have strong balance sheets. Obviously, on a one-off type basis for the individual investor, the answer is going to be it depends. I think with some of the big banks, the JP Morgans, the Bank of Americas, they might be more likely to lend depending if the borrower qualifies. Obviously, on the regional bank level, that becomes, again, on a case-by-case basis. But the lending window is open. In the past month, 2 months alone, REITs have been able to borrow, take down, frankly, billions of dollars of new debt.
Wow.
I want to say it's close to between $5 and $10 billion have been raised by a handful of REITs. And so the money is out there.
What about residential REITs?
Great place to be because of the housing shortage and lack of affordability. It's one of the core focuses of our Hoya Housing Index. And so as a result, when you think about the lack of affordability, it's the residential REITs, the apartments, the single family rental guys that benefit. And also, when you think about some of the other companies that are out there, because a person can't go out necessarily and buy affordable home, they're putting more, work into their existing home. And so again, one of the unique stories of the Hoya Housing Index is because we also include your Home Depots, your Lowe's, your Restoration Hardwares, because again, that affordable product isn't out there for the average consumer.
Can you explain to me how we got to this point, David, where we always talk about a housing shortage. How do we get there? How hard is it to build a multifamily apartment?
Well, obviously higher rates have impacted construction costs. So that's why you're not seeing a lot of new apartment projects underway. I also do blame the COVID run-up taking away some of that housing inventory since we saw, flippers and people taking down second homes, guys wanting to get out of apartments and, taking the first home possible. But, when you look at some of the hottest markets in the country as far as rentals, it's in your neck of the woods, in New York City. It's in Chicago. I saw a story that Detroit is one of the hottest rental markets right now. And so the housing issue is a coast-to-coast nationwide issue. You could point to pockets of areas that have more problems versus others because, again, of that affordability angle. But think about a rental project. I can rent an apartment here in Dallas for a couple of $1,000s, and that same apartment's going to cost me $4,500 or more in Los Angeles or San Francisco. So again, the number one rule of housing or real estate, location, location, location.
When you take a look at, say, the different REITs, is it going to be in large cap REITs, mid cap, small caps? How do you guys look at it?
We skew our high dividend yield index, the RIET, towards small and mid cap REITs. The reason being, REITs as a whole, they only make up about 2% of the S&P 500 or about 7% of the S&P mid cap 4, small cap 600. So we see a lot of opportunities and hidden gems in the world of small and mid-cap REITs. That's going to kind of provide that, I'd say alpha, that outperformance that you're looking for. we focus on dividends. And again, it's really those small and mid-cap REITs that offer the higher dividend yields. Our high dividend yield fund, I believe, is currently the only REIT and real estate product that's on the market that offers both common and preferred stocks in one wrapper. So with us taking a 10% allocation, or 1/3 of the names of RIET into REIT preferreds, if you add up small and mid-cap REITs, mortgage REIT exposure, plus our REIT preferred exposure, we're paying a monthly dividend that's annualized just under 9%. Nice. And if you just bought a large market cap weighted ETF like a VNQ, your yield is probably closer to 3.8% because, again, it's really focusing on those big, large cap names.
In terms of the dividends, David, what do you guys kind of value more, dividend payout or dividend growth?
That's a great question. Ooh. I mean, I hate to say it's a little bit of both. I think to the end investor, though, they really want the company to do four things: grow revenues, grow profits, grow dividends, and grow annual guidance. For a lot of the REITs, because a REIT is just a dividend income pass-through vehicle. So they want to make sure that they are obviously maintaining, if not growing, that dividend on an annual basis if possible. So I think you're kind of looking at both sides of it. How do we make sure that we don't have to cut our dividend? Mm-hmm. And what are the tools in place that we can put there to grow our dividend? And it's both sides of the equation. It's how do we maximize our revenue growth and minimize our expense growth? And for, like you talk about residential, mm-hmm. The big issue with residential right now is insurance, what we're seeing in Florida, unfortunately, with the hurricanes, and property taxes, especially for the single-family rental guys. So if they can minimize their expense growth and maximize revenue growth, that should hopefully lead to a higher dividend payment in investors' pockets.
Before we let you go, I want to also get your take on sort of other property sectors within the REIT market. Retail. When I say retail, what am I asking? Is it big malls? Is it like smaller retail presence? Like, how are those REITs performing?
Yeah, they've actually come out pretty well over the past couple of years when they were really kind of not really well received by investors. And I think it's due to a couple of things. Again, lack of new supply. It's not like we're building a ton of new shopping centers coast to coast. You're looking at an evolution of the product. A good example is Tanger, a typical factory outlet mall. The tenant offerings are different today than what you would have seen just a couple of years ago. A lot of these companies, also like the mall guys, are trying to bring in more experiential type offerings, not stuff that you can replicate online. And so the goal is to try to bring the family to the mall, provide them a lot of activities that you've captured that consumer for multiple hours in a day. But really, think about your typical grocery anchored shopping center. We're going to get groceries every single week, right? Obviously, we see the inflation side of it since the prices of a lot of the goods are up. But that anchor tenant, that grocery store, it's not like they're going away really anytime soon. Now, obviously, we've got some stuff with the Albertsons-Kroger merger that is going to kind of send some shockwaves through the grocery anchored industry. But I think with a lot of these REITs, with the relationships that they have and the experienced management teams, these anchor spaces are not going to be dark for very long.
All right. We appreciate it. Thank you so very much for joining us on those REITs. David Auerbach, Chief Investment Officer at Hoya Capital.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Tuesday, everybody. I'm Alix Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We're broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. We have a great Big Take story out for you. We love diving deep into all the topics and subjects that you need. It's a great Big Take podcast, and then you can also get it on Bloomberg.com as well as the terminal. And today's Big Take story is on how VW, so Volkswagen and Mercedes, are getting just left in the dust by China's EVs. The whole industry is getting squeezed by these cheap EVs from China. How do they recalibrate? Oliver Crook joins us now. Oliver Crook, Bloomberg Europe Correspondent, joins us. Oliver, it's been way too long since we chatted, so hello.
It has indeed.
It's so good to see you. We know that Volkswagen and Mercedes are struggling and are left in the dust. Just how far behind in the dust are they?
So listen, Alex, it depends kind of where you want to approach this question from. When we talk about the Chinese market, which again is a very key market for Mercedes, BMW, and Volkswagen, this is their biggest market, or has traditionally been their biggest market for a very long time. You look at just the third quarter deliveries that we got just a couple of weeks ago. BMW alone was down 30% in terms of the sales that they were making in China, and that is their biggest market. So that illustrates the scale of the importance of this here. The problem is that this is not just a question of the Chinese slowdown, right? This isn't a question of just we're going to put some stimulus in, demand's going to come back. The nature of that demand in China is now changing. So what we see now in the Chinese market is that more than half of the cars being sold there are EVs. And so while they still retain a lot of these German car companies, some of that market share, a good amount of that market share, it's really not in the EV section. And they're not even in the sort of top 5 or 10 in the leaderboard for EVs. So the question is, going forward, how do you get competitive again? The problem they have is they had that ICE market share. It's about winning that electric market share, and they're just way behind on the inside of the car and the electronics.
Yeah, the ICE is the internal combustion engine part, which is the hardest part for these guys. Is it actually the battery? Is it just doing it all cheaply? Or is it the bending in the metal for the EVs? Where is the struggle?
I mean, it's a combination of all of these things. There is, of course, there's the battery components, even the sort of the EVs that are sold here in Europe, even the ones that are produced here in Europe, the batteries are still coming from China. All of the components are coming over from China because they've really sort of been very proactive with their raw material policy. Everything from the lithium to this processing, that all goes on to China. The other issue is, of course, the cost base. And we're starting to see that hit here in Europe, where Volkswagen is talking about closing factories for the very first time in its history. They're talking about closing a factory in Belgium, closing a few factories in Germany. And to understand why that's so important, this is a company that has literally never done that before in Europe, in large part because, you know, their supervisory board, half of their seats are held by sort of union representatives. So if they are moving forward and making that decision, it's because things are very, very challenging. The cost base, if you look at the hourly wages of a sort of auto worker in Germany, it's close to like 62 euros an hour. You go to Hungary, just not too far away, it's 16 euros an hour.
Okay, how do they fix it? I know it's a silly question, but like, do they need a massive amount of subsidies to stimulate demand, or do they need sort of unions to get out of their way? What would make this process a little bit easier?
It's going to be a combination of all of those things. And one thing that makes it even harder, Alex, if we haven't talked about yet, is there actually are new EU regulations coming into force at the end of this year that basically stipulate that 20% of all the cars that they need to sell basically need to be EVs. The problem is there's a mismatch between what policymakers want and what the market wants right now. The market is stuck. These guys are still selling below 15% EVs. If they fail to hit that 20% by the end of this year, they're looking at potentially billions of euros worth of fines. So that's just another sort of overlay there. But this all, you know, I mean, the policy sort of dissonance that exists is one issue, but really these are car makers that have, it's partially their own doing, right? They were just far behind on this. The former Volkswagen CEO, he really wanted to lean into electrification. They weren't into that. They got rid of him. They brought in somebody new, and now they're really paying the price.
Oliver, how much of this is nationalism? We've seen with Apple, with the iPhone, maybe there's some concerns that the Chinese consumer on the margin doesn't want to buy Western products.
So listen, I think that that is going to be part of it. And of course, this is the Chinese policymakers have been trying to gear their sort of economy to not have the kind of dependencies that they've historically had. Remember, the Chinese were really sort of welcoming with open arms Volkswagen back in the 1980s when they first sort of started producing cars in the Chinese market because there was no automotive industry in China. What is interesting now is you're seeing some of these European car makers now sort of inverting that sort of same dynamic where you have the partnerships with, say, Stellantis and Leap Motor, a Chinese company, have a joint venture here in Europe where now Stellantis owns 51% so that they are starting to build Chinese cars at their own plants. And that is, so we talked about the sort of threat to the Chinese market. That is also coming very, very quickly and very soon to the European shores as well.
Which is so ironic because if Europe really wanted to green stuff fast, they would just import a boatload of Chinese EVs on the cheap and have their consumers buy them. To your point, then it becomes like a nationalist point. Paul, who's in the worst, who's in the best spot of this debacle?
You really put me on the spot here. We're going to try to get in trouble with some of these companies.
45 seconds.
I mean, listen, I'll tell you this. Stellantis is down 45% this year. They're down almost lost a fifth of their value since a profit warning 2 weeks ago. For thinking about companies that are really well positioned in Europe, you think about Tesla. They've got manufacturing over in Germany. And guess what? They make only EVs. So they're able to even sell some of those credits when those regulations kick in next year.
Okay. You see, you didn't. 27 seconds. Fine. What are you complaining about? He's totally fine. Oliver Crook, thank you so very much. Really appreciate it. Great to chat with you. Bloomberg Europe correspondent, joining us in the Big Take story. Volkswagen and Mercedes getting left in the dust by China's EVs. And you can read more of the story on Bloomberg and at Bloomberg.com/Big Take.
I didn't even think that would be a risk for the Western. I thought the brands were so strong over there that, and the quality was so much better, but maybe that's not the case.
I think maybe it's just a price point.
Yeah.
I mean, at this point. And like everyone wants the super cool luxury hot EV, right? Like that in essence isn't a problem. Like if you want to pay $1 billion for a Porsche that has an EV engine, no problem. But that's not the issue.
I didn't. I went with the gas.
Yeah, but you're not going to buy a Porsche. Okay, you bought your Vespa. This is different.
I bought a Vespa. Yes, I did.
Would you buy an EV Vespa?
No, please.
No, please.
No.
Okay.
John's got to draw the line somewhere.
I mean, but that's so easy. It's a little thing. You plug it in. Anyway.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.